Hi guys, good morning. And today we are going to share more insights into fixed assets accounting. Okay. In my previous video, I have shared some of the aspects on record to report, and this is a subpart of record to report, which is fixed asset accounting. Okay. Why I'm making this video is over the interaction that I have over the period of time, I've realized that though the candidates or the people working on this domain, especially in SAP, may be good in their day-to-day job, but there is a gap, a significant gap in the fundamental understanding of this concept. Okay, so we are doing that. It is an attempt to do that in this video. Okay, so let us start from the very basic, that what is fixed assets. Okay, so fixed assets can be, it's a larger term which can be used for tangible and intangible items, right? This is often called as property, plant and equipment. If you are doing IFRS or Ind AS accounting, now it is called as PPE or property, plant and equipment, right? These are actually assets or things bought in with a view of using it in the business and not for an immediate sale, and minimum usage period of these assets is more than 1 year, right? So these are called as fixed assets, right? What are the examples? Like building, land, machinery, vehicle, trademark, copyright. It is an example of intangible asset. Furniture, fixture, all these items are items of fixed assets. Now all the items of fixed assets will have depreciation, right? Or things like intangible assets, we call this amortization. Okay, we'll stick our discussion to depreciation right now. When the value of the asset, that asset which we have purchased, let's say a machinery, decreases over time, this decrease can be on account of usage of that machinery, wear and tear, or technological obsolescence, or by any other reason, right? This method, this decrease is called as depreciation. Okay. Uh, and there are many other reasons also why there is a decrease, but we will stick to the normal ones, which is use, wear and tear, and technological obsolescence. Depreciation, there are various methods of calculating depreciation. The two most common method is written down value method and straight line method. Okay. Apart from that, there is a unit of production method as well. Okay. So let's see what is a written down value method. Okay. So let's say you have purchased a machinery for 1 lakh rupees. Okay. And the residual value of that machinery is 5,000 rupees. So what is residual value? Residual value means the value which is remaining after the complete usage of that asset over the period of the life of the asset, right? Because you will sell something at least in scrap, right? So that is the residual value. So 1 lakh is the gross block and residual value is 5 lakh rupees. So how much value you will depreciate is 95,000, which is 1 lakh by 5,000 minus 5,000. Okay. And the rate of depreciation given in this problem is 20% because it is written down value method, right? So first you have to arrive at what we should be depreciating. We are depreciating what? 95,000 and not the total gross block. Okay. 95,000 into 20% will be your year one depreciation, right? What is the net value? Excluding the scrap value, the residual value is 76,000. Then in the beginning of the next year, you will calculate depreciation of 20% on this year two value and arrive at the net value. So this is the depreciation which you are going to calculate over the period of time. And this is the written down value method when you apply a certain percentage on the written down value of the asset, which is gross block, original gross block minus the depreciable, minus the residual value, minus the accumulated depreciation till the date, right? Because here, if you see, if we go down, it is 38,000 rupees, right? And 38,000 is the depreciable value. That means it has accumulated depreciation to the tune of 56,088, which is subtracted from 1 lakh rupees. So you see 1 lakh minus the residual value minus the depreciation charged till this date, right? This much is the depreciation already charged. So what is the value? Which is 38,912, and you will do the calculation and keep on doing this calculation. This is what written down value, where you apply certain percentage on the written down value. Okay, so you see the depreciation is different for each year. It is not same, and it is reducing as the year moves on, and there is a net block also which is there, right? Coming to straight line method, it is very simple, very widely used method. Okay, both are widely used, but little bit more straight line is used little bit more. Gross block minus the residual value divided by the useful life would be your depreciation, right? Here you see, right? Depreciable value is divided by this 95,000, which is depreciable value, is divided by 10 to get the depreciation amount for each year. And you see in this, the depreciation remains the same for each year. However, in written down value method, the depreciation is higher in the initial years and keep on reducing. In this, it is straight line. It is same year on year, and the net block becomes zero. In written down value, it does not become zero because some rounding of number still remains, right? So this is the straight line method of depreciation. The third method which we are going to discuss is unit of production. So let's say you have purchased a plant for again 1 lakh rupees, and the residual value is again 5,000 rupees, right? So what you will do is, and the unit which this plant is producing is 5 lakhs. So this plant is little different because the useful life is not determined through a depreciation rate or the useful life in years. It is basically the capacity of that plant to produce the number of units. Let's say it's a bottling plant and it is capable of producing 5 lakhs bottles, right? So what is the depreciable value which we have to depreciate is again 95,000, but rather than dividing it by the year, we will divide by the production amount. Okay, by the production amount. So 0.19 is the depreciation per unit of production. So let's say if the production is 50,000, right? In the next year, it has become 60,000, right? Here it has become 40,000, right? Here it has become 30,000, and here it has become 70,000, right? So the total production is 5 lakh rupees, 5 lakh unit over 10 years. But in whichever year the production is more, then the depreciation is more. Whichever year the production is less, the depreciation is less. So this is unit of production. Very, very infrequently used method of depreciation, but you should know it theoretically, right? This is the type of depreciation method which we have, right? Now, what is capitalization? When do we capitalize the fixed asset? And what are the expenses do we add in the fixed assets, right? So the IFRS says, if you see the IFRS definition, that we can capitalize any cost which is directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management, right? Or the word can be, which you can keep in mind, is cost incurred in preparing the assets for its intended use, right? If I have made this asset, if I have purchased a water treatment plant to treat the water for me, So till the plant is ready that it can treat the water, I can capitalize the expenses. It's simple. But once it is ready, you cannot capitalize the regular expenses for that water treatment plant, right? So we will do some examples also, and we will move forward. So like if you are doing the construction of the fixed asset, it is capitalized. If you are bringing in a fixed asset from a far off location, the cost of transportation can be included. The taxes, non-reimbursable taxes can be included. If you cannot claim, the credit of those taxes can be included as the cost of capitalization. Testing, whether the water treatment plant, which I took the example, is it working fine? So till the time you get a fit to operate certificate, if you are testing something, okay, then it can be capitalized. Those costs can be capitalized, right? So you have to see that cost incurred in preparing the asset for its intended use. Once the intended use is achieved, you cannot capitalize any further cost. There are few exceptions to it when you increase the capacity and all that, but in the normal circumstances, you cannot capitalize any further cost, right? Even the interest can be capitalized if you have taken that interest, if you have taken that loan for this capitalization, or even there are conditions where general loan can also be utilized, or if it can be prove that this loan is being taken for capitalization purposes or for capital expenditure, then also it can be capitalized, but it's a different discussion altogether. So I will keep it simple in this session today. Okay, what are the capitalization entries? Okay, so let's say when on the day when you purchase the asset, see the first entries. Okay, when you purchase the assets and it was ready for its intended use, like for example, you purchase some computers, you purchase some laptops, you don't need any installation, etc., right? It is ready, so you can directly capitalize on the day it is ready for its use. That means the day you have purchased it and started using it. So fixed assets account debit to the vendor account will be the entry for this, right? If the asset is ready for its intended use. If it is not ready, then there is another account which comes into picture, which is asset under construction account. Okay, let's say you are constructing a building. So building construction takes 2-3 years, right? So whatever amount you are incurring over this 2-3 years, what you will do in a very systematic manner, you will put it under asset under construction account. Okay, asset under construction account to vendor account, because you will keep on paying to the vendor, right? So, and when the asset is ready for its intended use, then what you will do, you will transfer the asset under construction account balance to the fixed asset account. So you see, in two situations where asset is ready for its intended use, the entry is fixed asset account debit to vendor account. And when the asset under construction, when the asset under construction, when the asset is not ready for its intended use, you will keep parking the amounts under asset under construction account, okay, and debit to vendor account, okay. And once the asset is ready, then you will do what you will do. You will pass an entry fixed asset account debit to asset under construction account, right? So asset under construction here is debit in the first entry, and here it is credit. So the amount will become zero at the end of the day, right? So let's see some live example. So capitalization example, company A purchased laptop at a cost of 1 lakh rupees from company J on 3rd March. So the entry in the books of company A would be on 3rd March when it is purchased, because laptop is ready for its intended use, right? So computer account debit to vendor account, right? 1 lakh rupees. This will be the entry. Next entry, company A purchased a water treatment plant at a cost of 5 lakh rupees from company M. Machine was delivered on 1st of February 23. Plant will need installation to make it ready for its intended use, right? Labor charges incurred for installation is 25,000 on 25th, 20th March. Water treatment plant was ready for use on 25th March, right? Clear? So we will go one by one. Machine was purchased or delivered on 1st February. So you will do the accounting asset under construction. AUC is also called as AUC. Asset under construction account debit to vendor account 5 lakh rupees, right? This is on 1st of February. And then you will pay the vendor and all that. That will happen, right? If you have paid, not paid, but asset has come into your books, right? Now on 20th March, you have incurred the labor charges also. So what will be the entry? Labor account debit, which is a nominal account, right? So debit the nominal account means it is an expense account to bank, right? So 25,000 rupees you have passed this entry, labor charges for water treatment plant. Then ideally, this is not an expense. This is a capital item. So what we will do for control purposes, immediately we should transfer this labor expense account to asset under construction account, or we do this as a part of the month end adjustment entries also, right? So asset under construction account debit, because it is asset, it is increasing. I will debit to labor account, labor charges account, 25,000, which is credit, right? So we have transferred that amount. So asset under construction has become how much? 5 lakhs plus 25,000 rupees, correct? And then on 25th March, the asset was ready for its intended use. So what I will do, I will transfer the amount of asset under construction to plant and machinery. So plant and machinery account debit 5,25,000 rupees to asset under construction. So the asset is capitalized, right? I hope I am able to make it clear with this example. How we will charge the depreciation? So let's see the entry for depreciation also. People, even in my discussions, people are who are working in FA also not able to give a correct entry for depreciation. Okay, so we will cover that. So company A has capitalized water treatment plant on 1st April 22. It's a separate example from the above. Okay, on 1st April is the capitalization at 5,25,000. Useful life is 10 years and residual value is 0. Right? Suggest the depreciation entry at SLM basis. SLM is what? Straight line method of calculating depreciation and presentation in the financials for 30th April 22. That is monthly financials. Okay. So what is the entry? The entry would be on 30th April, depreciation to accumulated depreciation. The entries which are passed in all the ERP software and even in Tally, you should create accumulated depreciation account. Don't pass directly to asset account. Okay, that's not the right way to do it. Though from accounting point of view, it is not wrong, but from controls point of view, this is not right. Okay, so you have to do depreciation to accumulated depreciation. How did we calculated this? 5,25,000 divided by 10 is 52,500 is the per year depreciation, and then per month depreciation is depreciation for the year divided by 12 is 4,375, right? So 4,375. So depreciation account debit. Depreciation is a nominal account. Debit when there is a expense. So depreciation is an expense. So 4,375 is the depreciation account debit to accumulated depreciation 4,375, right? This is the entry. How the presentation happens? Assume this is the balance sheet. Okay, this is asset side and liability side. So you do gross block. What is the gross block? 5,25,000 rupees, right? How much is the accumulated depreciation? Accumulated depreciation is also a balance sheet account. It's not a P&L account. It's a balance sheet account. So you will reduce the accumulated depreciation and do net block is 520,625, right? This is how the presentation is work. Accumulated depreciation, though it has a credit balance, but we don't show it under liability. We show it under gross block, less accumulated depreciation. Please do remember this, guys. Okay. Now, when you have purchased the fixed asset, you have charged the depreciation. There may be situation where you have to sell the fixed assets. Okay. So please listen to these questions. We have 3 examples. Repeat it, look at it again and again so that the concept becomes very clear to you. Okay. Example, company A has sold plant and machinery. Okay. The gross block was 5 lakh rupees. Accumulated depreciation was 4,90,000 rupees and it was sold at 60,000. Transaction date is 30th April. We have to do the accounting for this. Okay. So how we will do it? Very simple. Let's first arrive whether there is a profit or loss. Okay. So gross block is 50,000. Accumulated depreciation means how much depreciation we have already charged. 4,90,000 has already got into P&L as a cost already. So what is the net block? 10,000. That means what is the book value, net book value of this asset is 10,000 rupees in your books. At how much value you are selling this asset is 60,000, right? What is the profit? 60 minus 10, because you are selling it more than the net block of the asset, which is there in your books. So there is a profit, right? What is the accounting entry for this? Now, this asset will go out of the books because you have sold it. So asset has a debit balance, right? Asset is reducing. So you have to credit the asset, right? So you will credit the gross block, 5 lakh rupees, right? Accumulated depreciation is a liability balance, right? And this is also reducing. So you will debit accumulated depreciation, right? So here it is, debit accumulated depreciation. How much you have got in the bank? 60,000 rupees. So it is again an asset account. It is increasing. So bank account debit 60,000 rupees, right? And whether you have profit or loss, you have a profit of 50,000 rupees. So profit on sale of fixed asset is 50,000. You add up the entire general entry and both will have 5,50,000 rupees as the total. So the entry is on 30th April, accumulated depreciation account debit 4,90,000, bank account debit 60,000, gross block 5 lakhs, profit on sale of fixed assets 50,000, right? So please look at this fundamental, very important. If you are working in R2R, in accounting, in fixed asset domain, you need to understand these entries. Okay, guys. So let's move forward. Loss on sale. Same. Company A has sold plant and machinery, gross block 5 lakhs, accumulated depreciation is 3 lakhs, and it was sold for 60,000, right? So you see, gross block 5 lakhs, sold for 3 lakhs. Net block, net book value or net block of the asset is 2 lakh rupees. You have sold something which is worth 2 lakhs in your books at 60,000, whether there will be profit or loss. Definitely there will be a loss. So the loss is 1,40,000 rupees, right? What will be the entry again? You will close the accumulated depreciation account completely, 3 lakh rupees. You will debit the bank because you are getting the money, 60,000 rupees. Bank balance is increasing. So 60,000 rupees is this. And you will credit the gross block because you have sold this asset completely by 5 lakh rupees. And all losses are debited, right? So loss on sale of fixed asset is 1,40,000. Again, total this entry and you will get 5 lakh rupees, right? Loss on sale of fixed assets. Now there can be a situation where there is no profit or loss on sale of fixed assets, right? So again, gross block is 5 lakh rupees, accumulated depreciation is 4 lakh 50,000 rupees, and it is sold for 50,000 rupees, right? So see, 5 lakhs minus accumulated depreciation of 4 lakh 50,000, net block is 50,000, selling price is 50,000, no profit or loss, right? But again, the entry would be accumulated depreciation account debit 4 lakh 50,000 rupees, bank account debit 50,000, gross block 5 lakh rupees, right? So you see, prepare a ledger in your mind. The gross block balance was 5 lakhs debit, and you have credited it by another 5 lakhs. So the gross block balance becomes zero because now you don't have this asset, right? Accumulated depreciation balance was credit. You have accumulated depreciation debit by 4 lakh 50,000. The balance was also 4 lakh 50,000. Again, the balance is zero, right? And bank may you have got 50,000 rupees. So look at it in that way, okay? Translate it into ledger accounts also and try to understand the fundamentals of accounting, right? Now, there can be a situation where the assets are written off or completely scrapped, means you don't get any value of that asset, or during the fixed asset verification, when you do, you did not find that asset at all, and you have to write off in the books of accounts, right? So in those situations, what will be the case? Gross, you will not get anything in your bank account, right? You have to just write off the net book value, which is there in the books, right? So gross block is 50,000, 5 lakh rupees, and accumulated depreciation is 4 lakh 50,000, right? And net block is how much? 50,000, and company has decided to write off this asset, right? So what will be the situation? Sell price is nil, zero. So what will be the loss or profit? There cannot be profit because the net book value is 50,000. Now you are valuing it at zero. So it's a loss to you, right? So again, the entry is accumulated depreciation account debit 4 lakh 50,000 rupees, gross block 5 lakh rupees, right? And the difference of 50,000 rupees will be fixed asset written off. The name of the account can be different as per your chart of accounts, but fundamentally this is the accounting entry, okay? So with this, I think I have covered the fundamentals of the fixed asset accounting, the critical accounting aspects. I hope this is helpful to you, and thanks a lot. I'll come up with more videos on accounting concepts in days to come. Thanks a lot.